Joining us now, Thomas Hoenig. He served as both vice chair of the FDIC and president of the Kansas City Fed. He's now a distinguished senior fellow at Mercatus. And I love the piece I saw over the weekend in the Wall Street Journal. I want to get to that when we can, because there's a very similar op-ed today echoing a lot of your comments from over the weekend, Thomas. But we'll start with what we said. Do you think the Fed needs to stay the course and whatever happened the last 2 weeks, continue to fight inflation?
I think the Fed must continue the course, as difficult as that may be, because inflation, as they've indicated themselves, has to be the priority going forward from here. There is going to be further unease as a result of that, but if they don't get the inflation down, then they're going to have bigger problems later on, as we've witnessed in the past. So yes. You've
been warning for a while that maybe everything wasn't totally fixed with Dodd-Frank, and you key on one very important thing that now is front and center, and that is risk-weighted capital standards. If you don't factor in duration risk, then banks look much healthier than they actually are. That may have gotten SVB and some of the other banks that we're looking at now, got them in trouble. Now we're talking about an implicit guarantee for deposits, which just seems like it increases the likelihood that bank managers don't need to be that careful about capital.
Well, that's an issue. If you have the moral hazard that you're growing, when you bailed out all uninsured depositors with the Silicon Valley Bank, you set the expectation. And so I think that's why you hear the Secretary of the Treasury and others reemphasizing that depositors will be safe. And of course, that means there's less for the banks in terms of drawing deposits and less difficulty. And that's, in the short run, you understand that. But the effect is to cause bankers and depositors to take their eye off the ball as far as safety goes. And there is a long run cost to that. And I think that's, the risk-weighted capital, you're right. It measures what someone in the Fed says is a risk, rather than how much capital do you have to absorb losses from wherever they come on the balance sheet, including interest rate risk. So they've got to change that measure.
A pretty good paragraph here from the Journal today. A stable financial system requires clear and transparent capital standards. No. Sound regulation. I don't know about that. And above all, market discipline to punish reckless behavior. If regulators guarantee deposits once and when there's a run on a bank, why should we ever think that they wouldn't the next time? Isn't that a precedent that tells bankers that they don't need to be nearly as careful because they're going to get bailed out if there's a run on deposit? No bank can fail then.
Right. Well, bankers don't have to be as careful. Neither do the depositors or the debt holders, because they assume they're going to get bailed out. So yes, that's going to be a problem going forward. It's been a problem for decades. I mean, we have been the central bank and the Treasury have been intervening in the financial markets since at least the mid-90s, starting with the Asian crisis and the Russian financial crisis, and on from there. So the expectation's set. It will take a lot to change that expectation. One of the things they need to do is raise the capital level so that you internalize that to the stockholders. Right now, even the largest banks, if you look at their full balance sheet and the risk, they have capital that's around 5%. Off of trillions of dollars of balance sheet, you have a 5% margin of error. That's too low, and we need to address that going forward. We, the regulators, the Fed, need to have stronger capital standards so that someone at least has to be looking at these banks going forward.